Think about this for a second. If you have, $2 million sitting in short-term instruments right now, a standard Federal Reserve rate cut is not a reason to celebrate.
Oh, absolutely not. It's actually a massive red flag.
Right. I mean, it is essentially a $20,000 annual pay cut that just vanishes from your account overnight. So welcome to today's deep dive.
Yeah, glad to be here to unpack this.
Because for the mass market consumer, lower rates mean a slightly cheaper mortgage or like a better deal on an auto loan.
Right, they see it as a win.
Exactly. But when you step into the world of high net worth retirement planning, where you rely on a portfolio of $1 to $10 million or more just to generate your daily living expenses, a rate cut is a direct, immediate threat to your income.
It really is. It changes everything.
So today, we are exploring a highly specific, pretty high-stakes briefing from Davies Wealth Management. They are a fee-based fiduciary advisor out in Stuart, Florida.
Yep, great team over there.
Yeah, and they recently featured this on their show, the 1715 Treasure Coast Financial Wellness Podcast. Their analysis essentially outlines 7 critical moves for a $1 million-plus retirement income plan right now.
And it's so timely because, well, the macroeconomic event is uniform across the board, right? Interest rates go down. But the planning problems are entirely dictated by your portfolio size.
Right. The impact scales with your wealth.
Exactly. Like if your retirement relies on a target date fund and a fixed pension, you can kind of just ignore the Fed's day-to-day maneuvers.
Sure. It doesn't really touch your day-to-day cash flow.
But for an affluent investor relying on that consensus, mass market financial advice during a rate shift is incredibly dangerous.
Because of that $20,000 hit we mentioned.
Right. That yield reduction on a $2 million fixed income portfolio isn't just a one-time anomaly. I mean, it represents a permanent loss of compounding power year over year.
Okay, let's unpack this. The Davies Wealth Management briefing starts by tackling the yield trap, right? And this sort of illusion of safe cash.
Yeah, move number 4 in their framework.
Because over the past couple of years, parking cash in a money market fund and collecting 5% yield just felt brilliant.
Oh, so comfortable. Everyone loved it.
It was. But sitting in cash right after a rate cut signal is kind of like, it's like leaving your windows open when you know a blizzard is coming.
That is a great way to put it.
The source actually calls it a silent tax on your retirement income.
And it really is, because that floating yield drops almost instantly when the Fed acts. So to solve this exposure, the Davies framework applies a very deliberate 4-tier liquidity structure.
Okay, break that down for us.
Well, the goal is to completely separate your immediate spending needs from your long-term growth engines.
So you aren't backed into a corner.
Exactly. You never want to be forced to liquidate equities during a market downturn just to, fund your lifestyle.
Right. Selling at the bottom is the ultimate retirement killer. So I want to walk through how they structure those tiers because the timeline is what really separates this from generic advice.
Sure. So tier 1 is strictly operating cash. We are talking about 3 to 6 months of living expenses held in high-yield savings.
But wait, aren't those yields dropping?
Yeah, they are. But you accept the impending drop in yield here because the absolute priority is frictionless liquidity. You need that money fast and safe.
Okay, that makes sense. What about tier 2?
Tier 2 is your income reserve. This covers months 12 through 24, and this is where you utilize short-duration bond ladders or certificates of deposit.
Got it. Moving out a bit further on the timeline.
Right. Then Tier 3 is the growth and income engine. This is designed to cover years 3 through 10.
So that's where we start seeing the stock market come in.
Exactly. That involves a diversified portfolio of equities, dividend funds, and intermediate bonds.
Okay. And the last one, Tier 4.
Tier 4 is legacy capital. This is money that remains untouched for 10-plus years, so it's allocated to higher growth equities, alternative investments, or trust structures.
It's a beautifully structured defense mechanism, honestly. But looking at Tier 2, that income reserve for the next 2 years, how do you actually secure that before the rate cut hits?
Well, this is their first big move.
Right. The briefing emphasizes extending your bond ladder right now, but I really want to understand the mechanics behind that urgency.
What's fascinating here is the inverse relationship between bond prices and interest rates.
Right. Rates go down, prices go up.
Exactly. When the Fed cuts rates, newly issued bonds yield less. That instantly makes existing bonds, the ones holding those older, higher yields, way more valuable.
Okay, so you want to be holding those older bonds.
Yes, and there is a notoriously narrow window between the moment the Fed signals a cut and the moment they actually pull the trigger.
Right, the market prices it in so fast.
It really does. So if your capital is trapped in 3-month Treasury bills, you face massive reinvestment risk.
Because once those bills mature, you're just out of luck.
Exactly. You are forced to reinvest your capital at the new lower rates.
So to dodge that reinvestment trap, you stretch out the timeline. You lock in intermediate-term corporate bonds in the 4 to 7-year range, or maybe 8 to 15-year treasuries.
Right, that locks in the yield before the cut.
But the briefing also heavily highlights municipal bonds for this strategy. And why do munis suddenly become the hero in this scenario? Because I always thought municipal bonds were just these slow-growth tools for funding local bridges.
They are, but it comes down to the tax equivalent yield, specifically for listeners sitting in higher tax brackets.
Okay, how high are we talking?
Well, look at the 2026 projections. A single filer earning above $626,350, or a married couple earning above $751,600, sits in the 37% federal income tax bracket.
Wow. Okay, so the IRS is taking a huge bite out of any normal bond yield.
Exactly. But municipal bonds generally offer interest that is completely exempt from federal taxes.
Right.
So when you calculate what you actually keep after the IRS takes its cut, a high-grade municipal bond often severely outpaces a standard taxable bond.
That is a massive advantage. So we've essentially locked the front door by securing our cash yields and extending duration. But what about the back door?
You mean taxes?
Yeah. Rearranging a portfolio to chase yield can easily trigger massive tax penalties if you aren't paying attention. And here's where it gets really interesting.
Oh, the Roth conversion strategy.
Yeah, move 2 in their framework. The Davies briefing argues that a rate cut environment, which often brings market volatility and temporarily lowers portfolio valuations, is actually a golden opportunity for Roth conversions.
It is, even though the instinct for most investors during volatility is to just freeze.
Right, but I have to play devil's advocate for a second here.
Go for it.
If I'm looking at my traditional IRA, let's say it's sitting at $2 million, and market jitters temporarily knock it down to $1.6 million, why in the world would I want to convert that to a Roth at the absolute bottom? Doesn't that just lock in my losses?
It feels like it, right? But you have to mentally separate the underlying asset from its tax wrapper.
Yeah, what do you mean?
Converting the asset doesn't mean cashing it out. You are merely changing its tax status.
Oh, I see. You're just moving it from one bucket to another.
Exactly. So if you convert that portfolio when it's valued at $1.6 million, you pay ordinary income tax on significantly fewer dollars today.
Right, because it's quote-unquote worth less right now.
Yes. And then when the market inevitably recovers and the portfolio climbs back to $2 million and beyond, all of that subsequent growth occurs inside the Roth wrapper.
Meaning it becomes completely tax-free forever.
Exactly. You are essentially using the market volatility to buy your own assets on sale from the IRS.
That is a brilliant way to frame it, buying your own assets on sale. But, the briefing includes a massive warning label here, which is the IRMA cliff.
Oh, yeah. You have to be so careful with the IRMA.
Because you can't just blindly convert $1 million without setting off alarms over at Medicare, right?
Yeah.
Managing this IRMA cliff sounds a bit like playing the Price is Right with the IRS.
That is exactly what it's like.
Because if you go over by even $1, you don't just lose the game, you get penalized heavily.
Yeah, the Income-Related Monthly Adjustment Amount, or IRMAA, is one of the most punitive invisible taxes for affluent retirees.
And it basically just hikes up your Medicare premiums, right?
Right. It's a surcharge added to your Medicare Part B and Part D premiums based on your modified adjusted gross income.
And what are the thresholds for that right now?
For 2026, the threshold for single filers kicks in at a MAGI of $106,000, and it's $212,000 for married couples.
Okay.
And here's the kicker. It is not a gradual phase-in.
Whoa, it's a hard cliff.
A literal cliff. If your Roth conversion pushes your income just $1 over those specific lines, you get bumped into a surcharge tier that can easily add thousands of dollars in extra Medicare premiums for the year.
Wow. Which would just completely wipe out the long-term tax benefits you were trying to gain with the conversion in the first place.
Exactly. Precision is everything here.
So, zooming out to the day-to-day reality, how do you actually manage these landmines when deciding which accounts to draw from for your living expenses?
Well, Davies Wealth Management outlines a very strict withdrawal sequence to protect the portfolio's longevity.
Okay, let's hear the sequence.
First, You clear your required minimum distributions from traditional accounts. You manage that immediate tax hit right away.
Get the mandatory stuff out of the way.
Right. Second, you tap your taxable brokerage accounts, strategically harvesting long-term capital gains, which enjoy preferential tax treatment.
Okay, makes sense. And then,
Third, you draw down the traditional IRAs, but only up to the ceiling of your current desired tax bracket. You do not want to spill over into the next bracket.
right. And then I assume Roth is last.
Finally, yes, you touch the Roth IRAs last. You want to preserve that tax-free growth engine for as long as mathematically possible.
Now, there is a fantastic workaround mentioned in the briefing for managing those mandatory distributions without blowing up your adjusted gross income.
Ah, yes. The QCD.
Right. If you are philanthropic, they suggest using a qualified charitable distribution.
The mechanics of a QCD make it an absolute powerhouse for anyone 70 and a half or older.
How does it actually work in practice?
So in 2026, the tax code allows you to transfer up to $108,000 directly from your traditional IRA to a qualified charity.
Okay.
Because the capital goes directly to the institution, it satisfies your minimum distribution requirement. But, and this is the key, those funds never touch your adjusted gross income.
Which means it completely bypasses the IRMAA threshold calculations.
Exactly.
That's huge. You fulfill your charitable goals, you satisfy the government mandate, and you essentially hide that income from the Medicare surcharge formulas.
It is a highly efficient strategy, and honestly, it's something that mass market investors simply don't have the balance sheet to utilize.
Right. So this raises an important question about overall portfolio construction.
Yeah, zoom in out a bit.
Once you've secured the fixed income yields, and you've insulated the portfolio against these tax cliffs, you really have to examine the legacy assets, the massive equity positions.
Because falling rates dramatically shift the broader equity landscape.
Typically, lower rates make dividend-paying stocks, REITs, and utility companies look fantastic, right? Yield-starved investors just rush in and bid up those prices.
They do, but the briefing warns executives and business owners about a huge blind spot here.
Concentrated stock risk.
Exactly. If you've built your net worth working for one company and your wealth is entirely tied up in their stock, you are incredibly vulnerable.
Especially when the Fed is cutting rates, because economic uncertainty often travels alongside rate-cutting cycles.
Yes. Holding an illiquid, undiversified portfolio of a single employer stock during those periods is basically an uncompensated risk.
But here's the catch. If an executive just liquidates their entire concentrated position, they trigger a catastrophic capital gains tax bill.
Oh, it would be devastating.
So what are the sophisticated mechanisms Davies uses to unwind this without just handing half the wealth straight to the government? The briefing throws out terms like exchange funds and CRTs, but how do those actually work under the hood?
Let's break down the exchange fund first. It solves the diversification problem without triggering an immediate taxable sale.
Okay, I'm listening.
You essentially pool your shares of your company's stock with other executives who hold concentrated positions in completely different companies.
Oh, interesting. So it's like a swap.
Right. By swapping your shares into this pool, you receive a proportional interest in a highly diversified basket of stocks.
Wow.
Yeah. You defer the capital gains taxes indefinitely while instantly spreading your risk across multiple sectors.
That is incredibly clever. Get this safety of diversification without the tax penalty of selling. What about the charitable remainder trust, the CRT?
A CRT involves an irrevocable transfer. You move the highly appreciated concentrated stock into the trust.
Okay, and then what?
The trust then sells the stock. But because the trust is tax exempt, that sale generates zero immediate capital gains tax.
Wait, really? Zero?
Zero. The trust reinvests the full untaxed proceeds into a diversified portfolio and pays you an income stream for the rest of your life.
That sounds almost too good to be true. What's the catch?
Well, when you pass away, whatever remains in the trust goes to your designated charity. But you also get a substantial upfront income tax deduction the exact moment you fund it.
It's an elegant way to generate lifetime income while solving that concentration problem. The source also mentions covered call strategies and aggressive tax loss harvesting.
Yeah, those are more tactical moves.
Right, because selling covered calls essentially means you are collecting a premium from the market by agreeing to cap your upside on the stock.
Yeah.
So you generate extra income while you figure out your exit strategy.
Exactly. It pays you to wait.
And then tax loss harvesting allows you to systematically sell off loser assets to offset the gains you take when slowly unwinding the concentrated stock.
Right. But if we connect this to the bigger picture, All of these strategies require a real understanding of how deep the rate cuts might go.
Sure.
A true fiduciary doesn't just plan for a single quarter-point cut. Historically, a rate-cutting cycle lasts 12 to 24 months and can slice away 150 to 250 basis points from the benchmark rate.
That is a massive macroeconomic shift.
It is, and it requires rigorous stress testing. Move 6 in the briefing is all about this. A specialized advisor will actually model what happens to your specific retirement lifestyle if the yield on your money market funds gets slashed in half over the next 18 months.
Just to see if the plan holds up.
Right. They map out your exact tax exposure and IRMAA vulnerabilities under those new scenarios, just ensuring the portfolio won't fracture under pressure.
So what does this all mean? We've navigated the income replacement, the tax cliffs, and the equity risks. The Davies Wealth Management briefing saves the most counterintuitive twist for the very end.
The estate planning aspect.
Yes. Move 7. The exact same rate cuts that threaten your short-term cash yields are actually a secret weapon for generational estate planning.
It's wild, but it's true. And this hinges on a very specific, often ignored IRS metric called the Section 7520 rate.
Which, admittedly, sounds incredibly dry. But it is literally the engine powering the transfer of millions of dollars to the next generation. So what is it?
Basically, the 17520 rate is a benchmark hurdle rate. The IRS uses it to value the future growth of assets placed in various trust structures. When the Federal Reserve cuts broader interest rates, this IRS hurdle rate drops right alongside them.
So the hurdle gets lower.
Exactly. If the hurdle rate is set artificially low, say 2%, and the assets inside your trust grow at 7%, that 5% difference passes to your heirs completely free of estate and gift taxes.
You are essentially using the Fed's monetary policy to lower the bar your investments have to jump over.
That's a perfect way to summarize it.
The briefing highlights a few specific trusts that exploit this, right? Like the GRF.
Yeah, a grantor retained annuity trust, or DRATE, is highly effective in this environment.
How does that one work?
You place assets into the trust, which pays you an annuity for a set number of years. When the term ends, any appreciation above that low 7520 hurdle rate goes to your beneficiaries tax-free.
Wow.
Davies also utilizes SLATs, spousal lifetime access trusts. A SLAT allows you to lock assets away for your spouse's benefit, removing them from your taxable estate, while still maintaining indirect access to the funds if you ever really need them.
It's like having your cake and eating it too. But, the source also points out a much simpler strategy that doesn't require these complex trusts. Intra-family loans.
Oh, these are great right now. The mechanism there relies on the applicable federal rate, or AFR.
Right.
If you want to lend money to your children to buy a home or maybe start a business, the IRS forces you to charge a minimum interest rate. If you don't, they classify the loan as a taxable gift.
And nobody wants that.
No. But when rate cuts push that AFR down to historic lows, you can essentially become the bank for your family.
Locking in incredibly favorable, tax-efficient loans that keep the wealth compounding inside your family unit rather than paying interest to a commercial bank.
Exactly. It's a huge wealth preserver.
And there is a massive ticking clock on all of this estate planning, right? The briefing heavily emphasizes the federal estate tax exemption.
Yes, the sunset is coming.
Right now, in 2026, it is sitting at around $13.99 million per individual. But that exemption is scheduled by law to sunset and gets slashed roughly in half after 2025, unless Congress acts.
Which means high net worth families are staring at a profound window of opportunity right now.
It's like a perfect storm.
It really is. You have falling interest rates, which make these trust strategies mechanically more powerful, colliding perfectly with a historic high in the estate tax exemption just before an impending drop. The urgency to combine these factors is immense.
So synthesizing this entire briefing from the 1715 Treasure Coast Financial Wellness podcast, a Federal Reserve rate cut signal is a blaring call to action.
Absolutely. It's not a time to sit back.
To protect your $1 million-plus portfolio, you must immediately extend your bond durations and segment your liquidity into distinct tiers so you aren't forced into panic selling.
Right.
You must sidestep the IRMAA tax cliffs using surgical Roth conversions and QCDs. You have to actively de-risk concentrated stock positions through exchange funds or CRTs. And finally, you must turn those falling rates into an estate planning advantage before the tax exemption sunset.
And Davies Wealth Management emphasizes that executing a plan with this level of interconnectivity really requires a fee-based fiduciary advisor.
Yeah, you can't just wing this.
No, a generic mass market broker simply isn't equipped to coordinate your tax strategy, estate planning, and investment management all simultaneously. You need a partner whose sole legal and ethical obligation is your financial well-being.
And that brings us to a final paradox I want to leave you with today. Think about this. Central banks cut interest rates to stimulate the broader economy by making money cheaper to borrow.
Right, it's meant to be a stimulus.
But for the high net worth retiree, that exact same action silently drains the spending power of their hard-earned nest egg. It is a massive structural transfer of economic momentum from savers to borrowers.
It really makes you look at the headlines differently.
It does. So ask yourself, are you positioned to be the casualty of that economic stimulus or the beneficiary? Thanks for joining us on this deep dive. As always, keep questioning the consensus and take a hard look at your own portfolio. We'll catch you next time.